Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. And today I'm joined with Gary Zimmerman. How you doing today, Gary?
Hi, Kirk. How are you? Nice to see you.
Great, great. Glad to have you on the show. This is going to be a fun interview. For those of you who don't know Gary, Gary, tell us a little bit about your background.
Sure. I'm the founder and CEO of a company called Max, or Max My Interest is our URL. But it's really quite an accidental company. I entered college as a biochemistry major, thinking that I wanted to do medical research, but quickly found that economics was my calling. And after graduation, I followed a pretty traditional path as an investment banker, and I stayed for 15 years. I really loved my clients. I love the challenge. I love learning about new industries. But during the financial crisis, I stumbled upon what I ultimately found to be a massive inefficiency in the market for bank deposits. I left my job at the bank about a dozen years ago to see if we could pull together a solution for it. And today, we're now serving clients in all 50 states and working with financial advisors at about 3,000 wealth management firms nationwide, all helping their clients do better with their cash.
Yeah, it's cash is an interesting thing. I've been doing this for 26 years now, and I can tell you through my different experiences. I've had different experiences with cash. So I remember when I was at Payne Weber and Smith Barney, they had a very distinct view that cash is not good, and you should always be invested. Should always be invested in the markets or something, right? And it was a more broker-dealer centric view of always be invested all the time. There's no place for cash. They had a there's you couldn't do discretionary trading except for one program and you had to qualify. And if you did, I think the most cash you could have is like 1.5%. Like if you had more, they would actually yell at you and they would um there was no technical rule against it, but you were wrapped in the knuckles if you had more than that, which I found interesting. And this is right in the middle of 2000 to 2003, where the markets went down for pretty much 3 years in a row. And they still said, no, you have to be fully invested. And I found that fascinating. Now, what are you seeing when it comes to advisors, portfolios? Is that kind of like still widespread, a widespread premise? Because I don't do that now that I have full
Mhm.
autonomy. But back then, when you had, firms who have to tell you what to do, like, what are you seeing?
Well, Kirk, I think what you've uncovered is really the big difference between the traditional broker-dealer model and the RIA model, right? And I think your listeners are probably familiar with what an RIA is, right? It's a registered investment advisor. They're basically a financial advisor who is a fiduciary, who by law has to do what's best for you. That's very different from the old broker-dealers who are really they're salespeople, right? And that's not to say that all the people working inside broker-dealers are bad. That's far from the truth. But it's just really a difference in business model. And so in the old broker-dealer model, the broker-dealers made money based on stock trading, right? I'm simplifying, but that was a large part of the revenue model. And then over time, that business model evolved because they realized that they could earn spread on client cash as well. And in more recent years, you've actually seen some broker dealers create these model portfolios that force clients to hold larger portion in cash. One of them was fined several hundred million by the SEC for basically forcing clients into a product that wasn't necessarily right for them. But I think, if you step back, cash is fascinating because it is simultaneously the worst asset class and the best asset class. And what I mean by that is it's the worst asset class because at best it will return slightly more than inflation, right? And at worst, you miss out on enormous market opportunities. And if we look at the market since the financial crisis, so going back, roughly 15 years, the market's basically gone nowhere but up. We had a couple of little bumps in the road. There was a very brief 1 month recession during the pandemic before all the monetary and fiscal stimulus came in. But, sitting on the sidelines in this market has been a complete disaster. At the same time, there are other investors who a lot of people follow, like Warren Buffett, who hold very large cash positions. And his view is that cash is a strategic asset class and that there's a lot of value in having it, particularly when others don't, right? And he's been a very opportunistic investor in swooping in and making investments when everyone else was sort of out of liquidity. So it's kind of interesting. I mean, we as a company don't have a personal view or a professional view even on how much cash a client should hold. It's a very personal decision. But the one thing we do know from spending a lot of time with financial advisors is that most advisors are not aware of how much cash their clients hold, right? So, like a typical managed portfolio might have about a 3% cash allocation. And it goes back to what you were saying about Payne Weber, right? No one wants cash dragging down returns on the portfolio. And so most portfolios we see, it's equities, it's fixed income, some alternatives, maybe some commodities, and then like 3% cash, which is really there for trading and rebalancing and payment of quarterly fees. But where it gets really interesting is that if you look at the data more broadly, and we look at an annual report put out by the consulting firm Capgemini, they have a report called the World Wealth Report, and they look at affluent households all across the world. And when you look at the data, what it shows is that in 2025, their most recent report, the average high net worth household in North America keeps 25% of their liquid assets. So basically 25% of their assets, excluding their primary residence, in cash. And it's a bit of a head scratcher, right? You're like, well, how do we reconcile these two facts? How can it be that the investment portfolio is 95, 97% invested, and yet a quarter of a client's liquid assets are in cash? And the answer is that all of that cash is not in view of the advisor. It's sitting typically at a large money center bank where it is both underinsured and under earning. And this is where we identified the big opportunity that if we could help advisors work with their clients to uncover and discover that held away cash, then they could factor that into their planning conversations with clients. And in many cases, help migrate some of that cash into higher beta strategies so that the client could do better over the long term. Because, rarely will you find a financial advisor who would advise a client to keep 25% of their assets in cash over the long term.
You raised some great points. And I love talking about this as honestly, one of my favorite topics, and it's cash. And you think, well, cash is not sexy. It is one of my favorite topics because people truly don't understand how to use cash strategically. You see people like Ray Dalio who comes out and says, cash is trash. Okay, that's a nice soundbite. But um, I have this presentation that I do, and it talks about the myths and half truths of Wall Street. And one of them is cash. And, I always like to point out that if you have cash and you're invested in a bull market, you're losing out, right? That's obvious. Inflation is what it is, and, varies obviously. Let's say it's 3% for sake of argument. Um, well, it's a lot higher, but let's say it's 3% and the market's going up 10. Well, you're getting three, maybe four. I mean, right now you're getting four, depending on where you are. Um, hey, you're beating inflation or you're keeping pace with inflation, but you're not really doing all that hot. You're missing out on opportunities and all that. And that's so when people look at cash, they think, well, they're always thinking about the upside. Well, I'm missing out. Nvidia's going through the roof and Netflix and Tesla, I'm missing out, right? And their brain goes crazy, like, oh my God, I'm sitting in cash. What am I doing? And when the markets go down 30%, people aren't thinking that. They're thinking, oh my God, get me out, get me out, get me out. How do I get out? How do I not lose more money? And, you know, I think what people don't realize is there is as you said, a strategic advantage for cash. And here's how I frame it. If let's go back to 2008, right? The markets from peak to trough went down about 60%, 58 and change. But let's say it's 50 for sake of make the numbers easy. So if let's say you and I are two investors, right? You're fully invested through the whole way. You put in $100, and at the end of 2009, thereabouts, you have $50 because the market dropped 50%. So now you've got $50. I'm 100% in cash. So I still have $100. The difference is my $100 is worth twice as much as yours because now I can go buy the same stuff you have, but I can get twice as much of it because I didn't lose half my stuff. So I think of the strategic value of cash is in the value in not losing money when other people are and being able to buy afterwards when it's cheaper. And now, if you think about most of the bulk of the gains are made in those periods, if you can make money during those periods, you can beat the market very handily without taking a whole lot of risk.
Yeah, I mean, it's the same reason why you have, a portfolio that's balanced between equities and fixed income, right? Um, uh, it's really all about portfolio theory. And, we can bore clients really quickly by talking about portfolio theory, but the reality is that you have to have a long time horizon. Um, and we're in, I think, kind of a really interesting, potentially scary market right now, right? We've had a market that's gone basically nothing but up for 15 years. That's unusual. And there's a real tendency for people to be biased by recent experience, right? I mean, there's an entire generation of individual investors who've basically seen very low interest rates, right? For, zero rates for most of their investing career. That's also not normal. I can't predict the future. You can't predict the future. And I don't know of any individual clients who can predict the future either. And so you have to create a plan that will withstand a lot of different scenarios. And again, we don't provide financial advice. I'm not going to sit here and tell people whether they should hold cash or how much cash. What we know is that clients are still sitting on a lot of cash, and most of it is out of view of advisors. And if you look at the data, there are 18 trillion of bank deposits in the United States right now. About half of that is commercial. So cut that in half to 9 trillion for retail. And about half of that 9 trillion is held by the top 4% of the US population. Those are households with a million or more of investable assets. So that's only 6 to 8 million households sitting on close to $5 trillion of cash. And our view is that almost all of that cash is sitting in the wrong place. It's sitting in accounts where it is dramatically under earning and in many cases underinsured. And so the question is why, right? Why is it that when a client walks into, his financial advisor's office, he puts on a brave face in front of her. He's like, I want to be all in. I want, option strategies, and I want Tesla, and I want Nvidia, and I want, all of the sort of highest beta stocks. And yet that client then goes home and squirrels away, hundreds of thousands of dollars in cash sitting in a large brick and mortar bank account. And it all, I think, comes down to psychology. I mean, so much of what's interesting um, in this area is that it all ties back to behavioral finance, which is there's the difference between the um, sort of economic optimum and the way that people actually behave. But I don't think that people are irrational. I actually think it's quite rational. So the reason we believe that people squirrel away so much cash is that it helps them sleep better at night, right? Um, uh, there's actually a fun movie from the 80s. You might have seen it, Trading Places, which is based on The Prince and the Pauper, right? And the whole gist of the story is that it's much worse to have money and lose it than to never have it at all, right? People are terrified of loss. There's great loss aversion, and we know that that's an asymmetric emotion because if you look at how stocks trade on the way up, they sort of go up. There's a stochastic line, but they basically go up slowly. But when they fall very quickly, right? So people are much more afraid of loss. They're more fearful than they are greedy, to use Warren Buffett's terminology. And so that explains a lot about client behavior. There's actually some interesting research that looks at money and happiness. And this is an area that's really, really interesting to me, right? Because money shouldn't inherently make you happy. It's just pieces of paper or digits on a screen. But what money buys is choice, right? And money buys flexibility. And when they did this study of money and happiness, what they found is that the absolute level of your wealth does not, beyond a certain point, does not make you happier. People with, who don't have enough assets to live comfortably are less happy. But once you reach a certain level, and that threshold's pretty low, um, additional money doesn't actually make people happier. What does make people happier is holding a larger percent of that wealth in cash. And again, it's kind of funny. You're like, why would that be? I believe it's because um, having that cash on the sidelines gives you the comfort and flexibility, either to know that if the market falls 60% tomorrow, it's not the end of the world. I'll still be able to pay my kids' tuition and I'll still be able to, put food on the table. Um, but I think the other half of it is a lot of people are not happy in their jobs. If you look at the surveys, it's kind of sad, but a lot of people really don't enjoy their work. And that doesn't mean that they're going to quit, but knowing that they have enough money that they could quit makes them feel less trapped. I saw this all the time on Wall Street. It was fascinating because it's a tough job. There are a lot of tough jobs out there. Um, so anyway, there's a really, really interesting psychology behind this, and I think it explains why people hold so much cash. Is it right for them to hold so much cash? Well, I think that's a great opportunity for a conversation between a client and their advisor.
Yeah, I mean, you mentioned before, I want to point out, I'm not sure if you know about this about me, but I actually can predict the future, Gary. I'll tell you what's going to happen is the market is going to go up, down, and then sideways, but not necessarily in that order. So mark my words, I'm good at it.
You have a
Um,
crystal ball.
yeah, yeah. I will say you said people are rational. I want to call you out on that. I don't think people are rational because if you see what's going on now, and I believe Bank of America is still paying 0% or 0.01% interest on their cash, I believe. I'm not up to speed on it, but as of like, a few months ago they were. Um, People still have cash there. Why? Um, I can go get 4%, four and a quarter. I forget what it's paying now, but four and a quarter, let's say. And this is actually right before tomorrow's the Fed meeting, so it could be less. But basically, it's right around four, right? Is you're getting for your cash. Short-term treasuries, I can go, a few months out and I can get 4%. Money markets getting there. I believe you know better than me, but right around four. Um, but people still have their cash in Bank of America earning zero. So if people are rational, why would they do that? And secondly, why is Bank of America paying zero? Because they obviously don't want to compete for the cash when I can go to some other place and I can get close to that.
hmm Well, there's an information asymmetry, that is the way an economist would describe it. So, and it's really interesting too, because while the large money center banks, as you point out, are typically paying 0 or 0.01%, I think the national average on paid by on savings accounts across the entire country, including all banks, is 0.4%, so 40 basis points. The top rate on the Max platform today is 4.35%. So that's a really big difference, right? Imagine if you went to get your mortgage and one lender offered you a 4% mortgage and another lender offered you an 8% mortgage. 400 basis points or 4 percentage points of difference is a massive difference, right? And any rational human being would pick the 4% mortgage over the 8% mortgage. That exact same dynamic happens in the market for bank deposits. And it is a real quandary. How can it be that there can be such a large market that is so grossly inefficient, where today I'm earning 4.35% on my cash, and the person walking down the street next to me is earning 0.4% or 0.01%? And the answer is really simple, which is it's supply and demand, right? I don't think the banks are out to get people. I've worked at banks my whole career. They're full of lots of nice, well-meaning people. Um, I think the issue is that so much money has flooded to the largest banks because of a perception of safety. And those large banks say, I don't need any more deposits. Please take them away from me. And people still don't take them away. And so they could drop their rate and drop their rate. People still won't take them away. Maybe if they turn their rates negative, that might wake people up. But people are sort of asleep at the switch. They've resigned themselves to this idea that cash is a zero return asset class. And I know that's not the case because I've been following interest rates every day for the last 12 years. And I can tell you that never once has cash been a zero return asset class. So, it's really interesting when we talk to people about this. Um, you know, your primary banking account relationship is very sticky, right? Wherever you've had your account, you've probably had it there for 10 years or 20 years or 40 years. You're never going to switch banks. And we acknowledge that very early on, right? There's a lot of friction in switching banks. You've got to change your direct deposit and bill pay. And, um, for better or for worse, you're sort of happy with your bank, or at least sufficiently satisfied that you're not going to pick up and move. And that's okay. But our view is that, we'll just meet you where you are, right? If you're, we'll meet you where your primary checking account relationship is. But that doesn't mean that all of your savings have to sit at that same bank, right? So your checking account is there for your sort of personal working capital needs. Your paycheck comes in, your rent or your mortgage goes out, tuition payments go out. Um, you know, it's sort of an operating account. If you're a company, you'd call it an operating account. And the large money center banks are great at that. And I see no reason to switch away from that. But for your savings, for the cash that you're not using on a daily or monthly basis, that you might need on a daily basis, but that you typically aren't using, it makes sense to move those into a savings account. And once you're doing that, then it makes a lot more sense to shop around and try to find the best savings account rates because it turns out that there are a lot of banks in faster growing regions of the country that see a lot of lending opportunities in front of them, and yet they don't have the default flow of funds, right, coming from all these clients. And so they need to go out and raise deposits. And that's really expensive, right? They either have to go build bank branches or they have to go and do an online advertising campaign or they have to pay people for lead generation. And my thought was, what if we took all of that cost out of the system and we made it easy for depositors to find and open up accounts with additional banks in under 60 seconds? And in doing so, we could take a lot of cost out of the system and enable those banks to pay even higher rates than they might be paying elsewhere. And what we created was a much more efficient market. And lo and behold, if you create that efficiency in the market, you can earn much higher rates. And at the same time, we also designed our system so that it would help clients parcel out their funds across multiple banks so that it was always below the FDIC insurance limit, so that all the funds are always government guaranteed. And then kind of what's neat about Max is that it helps clients dynamically reallocate their cash to whichever banks are paying the highest rate in any given month. So we monitor interest rates daily, and whenever we see changes in rates, we help clients move their funds. And what that's created is basically a dynamic market where banks can attract or shed deposits as need be. And you're creating a true market-based mechanism, what an economist would call price discovery, where we can find out where the real willingness to pay is. And as a result, I've been using this approach since the financial crisis in 2009. We launched our company in 2013, and ever since then, our clients have been earning dramatically more than really anyone else in the country consistently. Not really doing anything special, still keeping money in their own FDIC insured savings accounts, but just being a little more thoughtful and active about how you pick those banks and how you choose to allocate those funds.
Yeah, I mean, one of the things I find, interesting when it comes to cash is I think people have such a very wide range of acceptance of what is um, how to manage cash. Most people, like some people have at most a month of cash. Some people are living day to day, which is getting harder and harder now with the economy. For most people, they're struggling, they're taking out debt, and so they don't have extra cash. It's just basically debt, which is a definite problem that's gonna hit people. The wealthy or don't have this problem, but certainly the middle, lower middle class is really starting to struggle. Um, but there's definitely people who are responsible, who live under their means and have a big buffer that will certainly help them. So the question I have is, um, what is a right amount? Because I think of things as you've got a cash, you've got an emergency fund, but a lot of people don't like keeping cash around. They want to keep it invested, which is not always smart because if you need it, then you got to pull out of the market, and if you need it, the market's probably going down at the same time. So, um, how should people think about cash? Like, what what should they keep in an emergency fund versus in kind of an operating fund? Like, how should people be thinking about that?
Well, you're right. I mean, first of all, half of the country really is struggling, right? I mean, there are various surveys, they all come out with roughly the same numbers, which is about 50% of American households can't come up with $600 to pay an emergency bill, right? That's a really scary situation to be in. My guess is most of your listeners are not in that situation, but they might have at some point in their lives been in that situation, or seen friends encounter that situation or family members. So for those who are privileged enough to have excess cash that's sitting around, it's a really good question. What is the right amount? I'm not sure there's a right answer. I think that's really specific to each individual person. Um, I remember when I was young, my mother gave me some important advice about the stock market. She said, Gary, don't invest anything that you're not willing to lose entirely. Now, some people would argue that's a really very conservative statement, and a little overboard, and you're never going to be able to retire if you follow that logic. But I think what she meant by that was don't, she was not encouraging me not to invest in the stock market. What she meant was you need to be able to psychologically withstand volatility, right? You need to not panic and sell at the moment when everyone else is panicking and selling. Because if you look at, there's data on the stock market dating back to the 1920s, I think, or 1910s. Um, and every financial advisor will show you that graph of basically the market going up in a sort of parabolic curve with a lot of volatility along the way. If you have the fortitude to stick it out, um, you've basically always been better off staying invested in equities. But what happens is that clients panic. And I'm sure, Kirk, your phone rings whenever, the market falls 10% or 5% or 20%, with panicked clients. And it suggests to me that they've maybe overinvested beyond their psychological, threshold for pain. But it's really important that you be able to withstand that pain so that you can stay invested so you don't make a mistake and panic and sell at the wrong time. And so the way that I think about cash is I want to hold enough cash that if everything else goes to zero tomorrow, I'm still okay. Um, Now I know everything is not going to go to zero tomorrow. I mean, I suppose that's a tiny, tiny fraction of a percent chance, but likely it's not going to. And if it does, everyone is going to be in the same predicament. But it's not that I need that much cash, but that's what enables me to ignore the ups and downs of the market and stay invested for the long term and sort of stick to the strategy. So that's one way to think about it. A lot of advisors will talk about having 6 months in cash. I think the key thing to remember is that as you get more senior in your career, it takes longer to find a new job because you are a more specialized asset. And you want to make sure that you're not just trying to find a job, you're trying to find the job that not only matches with your particular skills, but also, as you get more senior in your career, you earn the ability to pick who you work with, right? You don't just want a job, you want to work with people who you respect and who share the same values. Um, and so job searches for senior people take much longer than job searches for more junior people who are a little more interchangeable at that stage in their career. And so I think this sort of one size fits all, keep a 6 month cash reserve isn't necessarily the right advice either. For someone who's young, 3 months may be plenty. For a CEO, you may want 2 years of cash reserve because it might take that long to sort of find the next venture. And then, of course, you also have to keep in mind if you've made commitments to, private equity funds, you obviously need to reserve for those capital calls and that sort of thing. So I don't think there's a one size fits all answer.
Yeah, it's funny because the more complex your life becomes, the more complex the cash flow management becomes as well. You mentioned a few things, private equity commitments. Um, a lot of people, you think about buying a house. Like a lot of people stretch to get into a house just so they can get into a house, and then realize later, like, oh, I'm just going to earn more. That's my solution. I'll earn more, and I'll be fine. And that's great as long as everything keeps going up, right? Like the whole concept of inflation works if everything keeps going up. But if things don't go up, then it wrecks everything. It's like look at Japan. Japan peaked out in early 1990. and bottomed out, I think like 5, 7 years ago. It went down basically for 35 years. And only started to come back recently in the last few years. But imagine having, your portfolio go down for 35 years in a row, and your cash being worth more, but your debts, your cash being worth more if you held cash, um, but your debts don't go down like everything else. So your debts actually increase in comparison to everything else. And while normally a mortgage works because inflation eats away the mortgage over time and the value and all that, but in a deflationary environment, it's not pretty, right, with
It,
everything.
it, it's exactly right. I lived in Japan for 3 years. And while I was there, I saw my little, tray of sushi, takeout sushi went from 200 yen to 199 yen, right? That was deflation in action. It's fascinating. And there are so many things that we just assume to be true, right? We assume that things will always be a certain way. During the financial crisis in Europe, a lot of the banks went to negative interest rates. That was not a construct that people were familiar with. Today, we all assume that the Fed is going to stick to its target of 2% inflation. Um, Yet, if they do cut rates at their next session, I actually think they're going to exacerbate the problem. I'm probably in the small minority of people who think that they should not be cutting rates at this point, just purely based on the economic data. And if you look at what happened um, during the financial crisis, the government printed about $5 trillion of new money. That represented a 35% growth in the money supply. Cumulatively, since that time, we've only had about 25% cumulative inflation. And so it suggests to me that unless you think there's going to be a change in the velocity of money, um, that there's still more inflation embedded in the economy. We're going to continue to have inflation. And so I think it would be the wrong time to cut rates. Now, I'm in the very small minority. I think there's nearly consensus that the Fed is expected to cut rates. Um, but I don't think they should. So we'll see what happens. And
You
that's
and I are in
purely
the
based
same
on the
camp
data.
there.
Yeah.
I don't think they should have dropped it from 5. I think we should still be there. It doesn't seem to have impacted the economy, which actually raises a question. Do interest rates even matter anymore?
Oh, I think they matter a lot. I think the question is, um, you know, is the Fed credible? And I think the Fed is still credible. But I think anything that politicizes the Fed um, could really de-anchor financial markets because so much of financial markets are based on the long bond. And the long bond is based on basically long-term expectations on inflation. And you could see a dynamic where if short-term rates are cut, the long bond actually goes up out of fear that this will fuel more inflation. And so, everyone is looking at rates. Oh, we hope the Fed cuts rates because I really want to refinance my mortgage or I want to buy a new home. It's not clear to me that a cut in rates would actually drive mortgage rates down. It could do the opposite and drive mortgage rates up. I'm reading a really interesting book right now by Stephen King, not the guy who wrote Shawshank Redemption, but a British economist. And it's called We Need to Talk About Inflation. Um, and there's nothing particularly new in this book that I didn't already know, but the way it's written is really quite compelling. And I just sort of find myself nodding along with a lot of it. But what it does include are some really interesting stories um, from, all the way from the 6th century all the way up to, Germany in the 1930s. And what's fascinating is how inflation can be unleashed and how it can create really disparate outcomes in an economy. Um, in our current case, I think it's driving an increase in wealth inequality or wealth dispersion. And you see that every day. I walked around the corner to the grocery store and I saw there was a 1 inch thick box of Wheaties on the shelf. So it's not a very big box. Maybe that's 3 or 4 portions. And it was $10.29. And I bent down to take a picture of this box on the shelf, and the cashier looked over at me and she said, "They're stealing from us." And I said, it was sort of like an outburst, right? She's just like, "They're stealing from us." And I said, "Well, what do you mean?" She said, "The government is stealing from us by virtue of inflation." And I thought about it, and she's actually not wrong. I mean, inflation is a form of taxation. Um, and but it has a really significant impact, and it's particularly harsh on people who have little by way of real assets, right? Because as much as it might feel good for your hourly wage to go up, if your rent then goes up by 15%, that erodes that very, very quickly. Especially because your hourly wage is taxed, right? So you're actually only getting a portion of that increase. Um, and Whereas for people with assets, inflation is not terrible, right? Everyone is gleeful that the stock market is up so much over the last several years. If you actually compare the growth in the Dow to the growth in our national debt, one could argue that the stock market's not really up at all. These are nominal gains, but not real gains. Um, but as you pointed out, for people who have debt, inflation is actually quite wonderful because it reduces the real value of that debt. And the people who made the most money in 1930s Germany were people who borrowed a lot of money to buy businesses because there was massive hyperinflation. The debt basically was wiped out by virtue of inflation, and what they were left with was a business with nominal operating results. So I think a lot about this actually, Kirk. I think that the human brain is fundamentally wired in such a way that it doesn't understand viscerally three key concepts. In other words, humans are really bad at understanding the difference between real and nominal, compounding, and orders of magnitude. And I think it actually kind of explains society and where society is today, right? We don't understand. It's really easy to understand, oh, my neighbor has twice as much wealth as I do, or three times as much wealth, or five times as much wealth. It's very difficult to understand my neighbor has five orders of magnitude more wealth than I do. And I think if you were to ask most Americans to draw a curve of um, what does wealth dispersion look like in the country? They would draw a curve that's sort of like a fairly flat line and then would curve up a little bit at the end, right? And the reality is that if you look at the data, the actual dispersion in the country is sort of basically a flat line all the way across and then something that's asymptotic to the moon, right? People are just really bad at understanding these orders of magnitude of 10, right? You talk about what's the difference between a billionaire and a millionaire, right? What's the difference between, we're talking about maybe we'll have the world's first trillionaire. Um, so, um, but people we don't have riots in the streets, right? People are still fairly comfortable with that. So,
Not yet.
um, not yet. And well, and look throughout history, right? Almost every revolution was caused by a wealth disparity that got too wide um, for the populace. So we'll see what happens. But coming back to cash, whether it's cash or gold or I'm sure you'll have a whole separate episode on crypto. Um, but there is some logic to holding um, a sort of fail-safe asset. Again, because of humans' loss aversion, right? If you have a client, Kirk, let's say you've got a client with $10 million in assets, right? Probably a fairly typical client for you. 10 million in assets. Um, if they lost 10 million in assets, they would be really, really unhappy, right? And I'm sure that you protect them so that that's not a risk for them. But it's interesting if you were to say, well, I'm going to take 9 million of that 10 million and create a risk dynamic where maybe that will double and maybe it'll go to zero. Um, right? Is that client happier going from 10 million to 18 million? Or would they be happier, going from 10 to 1? In other words, the greed versus loss aversion are asymmetric. Um, and I think that coming back to sort of your first question, why do people hold so much cash? I think that loss aversion is a very strong and profound human emotion. Um, and while a client may not be brave enough to tell her financial advisor that she, wants to, set aside 20% of her portfolio in cash, the advisor will say, that's crazy. You're going to lag the market. But then she's just going to go and do it anyway in her bank account off to the side. So it's better to really have those conversations um, and do things purposefully. Your financial advisor is a lot like your doctor, right? You should never hide anything from your doctor. Your doctor is there to help you. And the more they know about your health situation, the better they can fit all the pieces together and diagnose things and come up with solutions. The same is true with your advisor. You shouldn't hide assets from your advisor, right? If you're afraid of sharing all of your information with your advisor, you probably have the wrong advisor, right? That's a
Yeah.
sign that you don't actually trust them. Um, but the more information your advisor has, the better, more holistic advice they can give you.
Yeah, no, I agree with that. I think there's we don't work with people like that if, we work with their entire situation because it doesn't work when you have multiple things going on and you can't do your
Yeah.
job. So but I think that's mainly changed. There used to be a time with the broker dealers where everyone was using brokers and they were just using different brokers and no one was doing the advice. They were just selling stocks. And I think that's changed quite a bit. I will say this, you mentioned something about you worry about the Fed being politicized and losing their respect, if you will. I would argue that they've already done that. I mean, they lowered 50 basis points right before an election. That's political. No one, I didn't hear a lot of people calling them out, but that was just kind of like, ugh, like it was just so obvious and just, I mean, I know Trump's out there yelling and screaming at Powell, and I get that, but I think the Fed has slowly eroded their own people's confidence in them over time, and I do wonder, you know, there's a lot of changes afoot in the financial industry. Um, I certainly think we should be back in 5.5% interest rates. I don't think we've earned a drop, but I get it. Everyone wants the markets to go up. But the reality is, and the reason I asked my question about if interest rates matter is in 2022, interest rates went from virtually zero up to like 5.5. The Fed funds rate did. And that obviously caused the markets to have a little bit of chaos. However, real estate kept going up. No one seemed to care that interest rates are going up, mortgages are going up. No one seemed to care. People kept buying houses. They're still buying them today. So the reason I asked the question is because, in my opinion, I think the financial system is broken in a way that people don't fully realize.
Hmm.
And I'm not sure why or how. I'm speculating a little bit. I have some theories, but if you really think about it, interest rates are inversely relationship to prices, right? So higher interest rate, lower prices.
Hmm.
Lower interest rate, higher prices, right? You'd say, well, we had low interest rates for a long time. Real estate kept going up. Yeah, but when rates went up, real estate kept going up. So it's not, there's something amiss. Um, and I haven't heard anybody really put a finger on it because people say, well, it's just supply and demand. Yeah, maybe. But now interest rates are going down. What if real estate starts going down like it is? Like real estate started to go down as interest rates started to go down. What are we missing? So my point is that, and this is the crux of my question, and we have to wrap it up here in the interest of time. Um, with the way things are set up now, with crypto, with blockchain, with all the changes in the financial system, what should people be thinking about, and how are things going to be changing so that people can stay abreast of it, so they're not sitting in cash when maybe it should be stable coin? I'm not suggesting they are. I'm just saying like
Hmm.
that's the direction we're going is more stable coin-ish stuff because that's where the trends are going. So what should people be thinking about, and should their thoughts around money, cash, stable coin, whatever it is, should that change, or are they effectively the same and it's just a different vehicle?
Yeah, I'll answer your question on stablecoin in a minute. I just want to come back to something you touched on real estate prices because this is something that's really of import to pretty much everyone. Um, you're right. Something's amiss. Something doesn't make sense, right? When interest rates went up significantly, real estate prices should have come down and they didn't. And so there are only two explanations I can think of. One is the supply and demand question, which is no one's willing to sell their home unless they have to for job change or for other reason because they've got this locked in interest rate that's, an historic aberration, immensely low. That is a real asset with real value, and you'd be crazy to give that up. And so because of that, there is, few people are selling their homes. They're like, I can't afford to sell my home. Even if I were to sell it, I couldn't buy the equivalent home today because the new rate would be so much higher, even though rates today are only about historical average. They're not actually high, but they're higher. So that's one explanation. The other explanation is that the market is perfectly rational and we're in for significantly more inflation. Um, at which point the nominal value of homes should go up. It doesn't mean that they're appreciating in value, right? The real value may not be increasing, but it may be that there is a lot more inflation ahead. And in an inflationary period, it makes sense to hold on to real assets because the real value of the debt will go down and the nominal price will go up. So I think one of those two is likely the explanation. It could be a mix of them, but if you look at affordability of housing, it makes no sense, right? The housing stock is just too expensive, and that's going to cause problems for the economy. In terms of all of the stable coin stuff, I'm not really sure there's anything there. Now, I could be wrong. I've been wrong on this. I turned down the opportunity to buy Bitcoin at $173 a coin, and I still stand by that because I still think it's fundamentally worthless. Um, but that doesn't mean it won't have a large market value, right? Because there are some good arguments for why it makes sense to have an asset that is um, separate and distinct from the money printing capabilities of the government. Historically, governments have never allowed that sort of thing to exist. So we're in a bit of uncharted territory here. Um, anyway, the stable coin stuff is simply a digital representation of an underlying treasury security. And the only difference is that the issuer of it is keeping all the yield for themselves in many cases, right? So it's a phenomenally profitable business model. Um, there may be some applications in international trade. The reality is we already have a digital dollar. It's called the US dollar, and you can wire funds and you can move it instantly and without having to worry about whether the underlying collateral is actually there. So I think that a lot of the crypto stuff, well, blockchain technology is really interesting. A lot of the crypto stuff, in my humble opinion, is really a solution in search of a problem. Um, and I would tread very carefully. I always correct people whenever they call it an investment. It's not an investment, it's a speculation. And there's nothing wrong with a little speculation in a portfolio. People do that all the time when they invest in early stage tech companies. But I don't consider it to be an investment. I think of it as sort of it's not even an uncorrelated asset class. It's actually if you look at how a lot of these cryptocurrencies have performed, they're risk assets.
Yeah. Well, I appreciate that answer, Gary. We have to wrap it up in the interest of time. Final thoughts from you, and where can people find more about you?
Um, well, our website, maxmyinterest.com, has a lot of information for individual clients, financial advisors, and banks. We really sought to sort of create a win-win-win solution for all of those constituents.
Awesome. Well, Gary, I really appreciate you coming to the show, sharing your wisdom with us. And yeah, cash is not going away, so probably have you back on in the future as I know dynamics are definitely going to change. So thank you again for joining us.
My pleasure, Kirk. Thank you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right. Well, that was a great interview with Gary. Really appreciate him coming on the show. Now we're into the panel portion of the show where you have our very own Dinah Perkins. Hey, Dinah.
Hi, Kirk. Thanks for having me on.
Yeah, glad to have you. Well, let's dive right in here because I know we're just you and me today. Just just a short panel. Barb was under the weather, so she had a last minute cancellation, but that's all right. We'll try to fill her big shoes. So what were some of your takeaways from the interview, Diana?
Yeah, I think one of the biggest takeaways for me is the theme around money mindset and the psychology of investing. I think that's an area that's actually not talked about enough. One of the themes that came up was around, fear and greed, right? Driving the markets and driving investing decisions. But you don't want investing decisions to be driven by fear, right? It should be driven by strategy. And I think it's not a question of whether cash is either good or it's bad. It's really a question of, is your cash working for you or is it just sitting idle? I think it's no surprise with my trading background when I hear the term cash, I put it in the bucket of boring. Although I also used to charge my family members interest when I was a kid when they borrowed money from me. So I do see the value. But I'm a strong believer that, if your cash isn't working for you, or if any investment isn't working for you, it's essentially working against you. And it's not really a return strategy, but more of a risk strategy overall, which I do agree is a very personal decision.
Yeah, it's cash is so interesting because people have such strong opinions on it. Um, it's if you think about like Ray Dalio he says cash is trash. He says this a lot. Cash is trash. Well, it depends on your perspective. And I think we all live most of us live lives with a lack of perspective. We live in a binary culture, right or wrong, black or white, yes or no. This person's good or bad. I just listened to a podcast and we're like, this person's bad because of X. Okay, is everything they said bad or just a handful of things? It is, because I've listened to this other person and I don't particularly like them. I'm not going to mention the name because immediately I'll draw fire from everybody. But this person who is very polarizing, and I certainly don't follow him. I've never even listened to him, but I just hear how he's talked about. And then I heard a clip of him talking, and 90% of the clip I agreed with, and 10% I was like, okay, well, I didn't agree with that comment, but is everything else he said correct? Yeah, it is correct. But you have one comment or how they think, it just colors everything. So everything they say is bad, or everything they say is good, depending what side you're on. The reality is we live in this nuanced life. And I had a conversation with somebody actually last week about this, and they're like, I don't really like this podcaster because they interviewed so and so and they platformed him, and I didn't really agree with his views. I'm like, okay, so what? Like, you have to be able to disentangle the person's views from like the topic. Like, if I don't like aliens, if my opinion is I don't like aliens, and you like aliens, you're gonna hate me. Now, if I say like, cash is trash, you're gonna be like, well, that's not true because he hates aliens. So cash isn't trash, and that's how our minds work is we color everything like 100% or zero. And life is not that way, right? That's not how life works. And so when you hear people like Ray Dalio say cash is trash, Ray Dalio is very smart. He's a lot smarter than me. He's got a lot more experience and he manages like the biggest hedge fund in the world. Like he's a smart guy. Um, I'm not taking that away from him, but his comment is nuanced. And of course, nuance doesn't get you any attention on the internet, so people don't like nuance. But his comment is nuanced. If you hold a dollar for 100 years, yeah, it's probably going to be worth 3 cents at the end of it. But who the heck is going to do that? No one. So showing me a 100-year chart of the dollar going down 97% is virtually useless. Because unless you stuck dollar bills in your backyard and then you found them, your heirs found them in 100 years, like, oh, look at all these dollars, they're not worth anything. Well, okay, who's doing that? That's silly too. The value of the dollar is not in trying to outperform the index. It's not trying to outperform inflation. The value of the dollar is liquidity. That's what people don't get. Liquidity is one of the most important things because if you have liquidity when no one else does, you're the king, right? As they say, the one-eyed man is the king in the land of the blind. If no one has liquidity and you do, you make the rules. Like in 1929, when like everyone, like no one had cash, like there wasn't any cash available. If you had a pile of cash, you did whatever you wanted to do, right? You think of JFK's dad. I forget the guy's. What was his dad's name? Robert.
Robert F. Kennedy?
Robert, yeah, his dad, yeah, the guy who basically he was like questionably in with the mob, and like he had all these great deals that he bartered for his family, and like at the top of the market he got out and bought a bunch of cab companies. Like here's a guy who's connected, but he knew that cash was valuable, and he got out and he used it to buy all this stuff and make his family an immense fortune, which lasts today, 100 years later. That's the value of cash. It is not in beating inflation because you don't need to beat inflation every single year. Because if the market crashes, let's say the index goes down, let's say the S&P goes down 50% tomorrow and you have a pile of cash. Your cash just appreciated 100%. You might say that doesn't make any sense. The cash didn't do anything. Yeah, relative to the S&P 500, because today my $100 can buy one share of the S&P 500. Tomorrow, when the S&P is down 50%, it is now worth $100, 100 shares. So my $100 worth buys one share of the S&P. Tomorrow, my $100 buys two shares of the S&P because my cash didn't change value, but the S&P did. So relative to what you want to buy, it appreciated 100% because now I can buy twice as much stuff. So the value of cash is in relation to everything else. That's what most people don't get. Most people look at cash as stable and they see the S&P is going up, it's going up. Well, great, the cash is not going up. Yeah, but the S&P goes down. They don't look at it as the cash is appreciating, but it is in relative to the S&P. So everything is relative to something else. So I'm not going to take over this whole thing. I'm going to let Diana talk a little bit. But I wanted to kind of put that out there because I don't think people really grasp it. And it's a hard concept to grasp because we all think of things in a static way. Like, a loaf of bread is $10. But if you go to Europe, the old Europe, where they had like every country had its currency, like you were always trying to manage one thing in comparison to another. So you got the concept that it's comparison to something else. But in the US, everything's just static. So you're like, well, the world doesn't matter. This is what it costs. But that's not really how things work. So I don't know. What are your thoughts on that, Diana?
Yeah, so I agree with the relative value, and I think that's why diversification is so important across different asset classes. Now, on the example with the stock market crash, I would challenge how often does that happen? So, yes, if you're sitting in cash, right, you're one leg up against all others. But look how often we're in bull markets. I mean, I think it was argued in the interview, we're in 15 years and, I pushed back a little bit around the COVID time, but generally the market's moving up. So you don't want to manage to the exception either. I do feel that there's a place for cash, just like I feel that there's a place for both fundamental and technical analysis in trading, but it needs to be strategic and not just by default.
Yeah, I agree. I think you make a great point about, not sitting in cash forever because you don't know when the next crash is going to be. And I totally agree. There used to be a time where crashes happen. I'm not sure if that time exists anymore. Like, and I say that, being mindful of the fact that of course I could be wrong. But if you look at the crashes, right? We had a dot-com bubble burst. The Nasdaq lost like 80% of its value. You had the housing bubble burst. Real estate, I mean, some places went down 50 plus percent, right? We had those crashes. But then you had COVID. The market went down 30 some odd percent when the whole global economy was shut down. No one was making any money. And yet, it's only down 30 some odd percent. How the heck is that possible? The only reason we didn't go all in like March and April, despite the Fed kind of like, liquefying the system, was because the whole global economy was shut down. How the hell doesn't that mean that the stock is worth zero? Because you have no cash flow, right? So, in many ways, all of these things kind of make me wonder. And I don't say that it's rational because the markets aren't rational. I say it because I wonder if the next crash will be less bad than COVID. And 30% is not easy, but it should have been 50 plus. Um, but if you really kind of run the numbers, like 20%, like, is that a bad crash now? 20%? Well, 20% is not that bad. I would say in any given year, the market generally is going to have a 10% decline in most years, sometimes 20% if things are rough. But more than 20, it rarely happens. To Diana's point, like it almost never happens, except for when there's a crash, if you're getting greater than 20. I've seen it hit 20 a bunch of times and bounce. I've seen it hit 10 and bounce. Like it seems to be kind of like the magic number. But the question is the crash going to happen? Well, if you go by the assumption that of what I just laid out, that it's not going to happen because of X, then everyone else is thinking the same way. So what if it does? Then you're not going to be in a position to take advantage of it. So the real question isn't should you do it? The question is how you do it. So Diana, I mean, you're obviously a master trader in what you do. Um, you don't think about things like other people do. How would you think about this problem of like, solving this problem? Like what can people think about to solve this challenge of taking advantage of liquidity but not sitting in there for 100 years?
Yeah, so first of all, I mean, timing the market, just like you're talking about timing market crashes, that is one of the hardest things to do. I know this firsthand as an options trader. So you don't, I always say, trade the market in front of you. It will tell you what it's going to do. Also, to the point around, COVID, it dropped, around 35%, bounced back pretty quickly. And this is a worldwide pandemic, almost unprecedented. And to that, I would say, perception's reality, right? And the market moves on greed and fear. It is irrational. We don't know what it's going to do next because it's not always logical. So in terms of a strategy and how do we deal with this emotional market, I refer to it as organized chaos. The financial markets, organized chaos. So how do we deal with that? How do we think about that? Now, first and foremost, I always say never trade or invest in more number one, more than you can afford to lose. I think that actually came up in the interview. It's my number one rule as part of a premise for my business. Never invest or trade anything you can't afford to lose if you're in riskier investments. Is first and foremost. And no investment or trade should keep you up at night. So if you need to have a certain percentage of your investments in cash or cash equivalents to meet that criteria, then I think you should. It's very individualistic. I mean, personally, I have a probably when we're talking about relativity, a relative high tolerance for risk, very, very high tolerance. But I also understand that most people don't, right? And it depends on, your time frame, your investment goals. So based on those criteria, whether you have 95% of your financial assets, tied up in the stock market, or if you have 80% sitting in cash or cash equivalents and 20% mixed between, bond funds and stocks or in mutual funds, it's very much an individual decision. So the way I would look at it is, think about what are your investing goals in terms of return? How much are you willing to risk if there is a market crash that comes up unexpectedly? Do you have time to recover? So risk tolerance, your goals, and that time frame, which really kind of overlays both of those things.
Yeah, it's funny how important time is in the equation, and it's something that we almost never look at, right? A friend of mine calls it time dilation, right? And it's that we have good perspective in the moment, right? We look at a set of facts and we're like, all right, this is the answer. The problem is time is sliced in seconds or minutes or however you want to slice it, right? And it's here and then it's the future. We only look at today. We're not good at looking at the future. We're good at looking at the extreme future. Like, oh, well, the market's going to get bad and everything's going to go to zero. And we're going to be living in caves and eating MREs and I'll be there with my guns and my gold. Like we're good at looking at that, the zombie apocalypse scenario. We're also good at looking at the Garden of Eden scenario. Everything's gonna be perfect. Nothing's gonna be wrong. AI is gonna take over, and we're gonna live a life of leisure, and we're never gonna have to work again. And we're good at looking at these extreme scenarios. We're not good at looking in between. It's based on our bias. Our bias is a big part of it. So if you think about how to think about cash, you have to understand the time dilation. Like, what is your time frame? What is your duration? Right? Like Diana was talking about. Like when you're dealing with options, you have a duration, a fixed duration. It could be a day, it could be a week, it could be a month, it could be a year, like depending on the option. You can decide what time frame you want to put this together. So if I'm worried about the stock market, I might buy a put on the S&P 500. And I got to pay for that. It's insurance on the investment, so I got to pay for it. And if it doesn't pay off, well, I lose that money, but I am protected in the case of a crash. So my question is do I need to do that? Well, this gets back into the binary thing. It's not a binary decision. It's not a question of if, it's a question of how. So should I do it or shouldn't I do it? Okay, well, maybe you don't do all of it. Maybe you just do a little bit, right? Maybe you protect 10% of your portfolio or 30%. Maybe it's not 100%, right? You got to come up with these things. But ultimately, you have to figure out, you have to think about different potential outcomes. So this is how I think about it. I'm curious your thoughts on this too, Diana. But like I think of the world in terms of scenarios. What are the different potential scenarios that could happen? So yes, the market could crash, it could get ugly. That's one scenario. It could also go straight up. That is another probable scenario. Now, it's hard to square those two things in my mind. The market could go down in a crash, or it could go up another 40%. That's hard to square that. Those are complete opposites, right? Or it could stay the same. It could just go sideways for a while, right? Or somewhere in between. But those are all different scenarios. Well, how do you keep that in your mind at the same time? Well, F. Scott Fitzgerald has a famous quote of I'm going to butcher this, but the sign of a first-rate intelligence is being able to hold two contradictory ideas in your mind at the same time and still function. That's effectively what he says. I paraphrase a little bit, but that's basically what he said. So if that's the case, I know it's hard. Like he said, it's hard. I know it's hard. Everyone knows it's hard if you try it because you have to be able to be unemotional about the outcome. But we're never unemotional because we're emotional human beings. So that's the difficulty, is being able to look at one side and the other side and not have necessarily an opinion on it, but have a resolution as to how you would act in the case of that event. So how do you handle stuff like that, Diana? Because you trade a lot and you must deal with this every single day.
Yeah. So, and well, first of all, in terms of thinking about extremes, I think it's important to stress test your strategy. So, best case scenario, worst case scenario, but don't get too excited about one or fearful of the other. They're just almost like the guardrails, right, to your portfolio. So that's number one. And then within that, it's, what is the likely scenario? So as you know, I mean, I am a trader. I rely heavily on technical analysis, a lot of historical information. It's price action. So we're looking at in this given time frame, how likely is it for this particular stock or asset to appreciate or depreciate, given past movements, with or without a catalyst. So I'll look at in terms of risk and return, individualized. I'll know what those extremes are, but I'll play in between those guardrails. And I think what a lot of investors or active traders, active investors will do is they'll just look at that one trade or investment individually and sometimes get very attached. I see this a lot. And I always say, you should never be married to a trade or investment. Just like you said, it's a very objective decision. When it comes to money, it should be about money. It's all business. So there shouldn't be emotion. So you know your extremes, the maximum amount you could potentially make in the time frame, maximum amount you could potentially lose. But what a lot of investors or active traders don't look at or lose sight of is overall their portfolio, the broader picture. What is that maximum drawdown amount? What is that maximum return given the parameters of each of these investments? So looking at that broader picture and understanding, okay, it's not just I have, this amount in stocks, this amount in, bonds, this amount in cash. It's within those buckets, looking individually, how much risk exposure do I have? And then overall across asset classes, how much risk or exposure do I have for that particular area? So really it's about understanding those extremes, best case, worst case scenario, and then also within that, what's probable, what's my exposure, and not just being rosy colored glasses, because I mean there is an emotional tied to money. We talked a little bit about the mindset, and we want to be realistic.
Nice. So I want to talk a little bit before we kind of wrap it up here of the banking system challenges that we see now. Certain banks, one of the biggest, I won't name them because I don't want to get sued. But if you look at banks and what they're charging on interest, some are charging better than others. Most of them are charging zero still, even though interest rates went up to 5%, they're still charging zero. How should people be thinking about their cash? Because getting back to what we said earlier, liquidity is important, right? An emergency fund, one of my stipulations is everybody should have an emergency fund. An emergency fund is just liquid cash. The goal is not to grow it. I mean, it should be as liquid and as safe as possible. Now, there are many ways to do it that aren't earning you zero, to be clear. But the goal is not to outperform the markets. The goal is to do the best you can, but liquidity is the utmost important thing. And so, how should people be thinking about that problem? In the wake of many banks paying zero, and even frankly, if things come to pass as I start to see them, interest rates could be going down a lot. And that means people's cash will be getting even less and less return. So how should people be thinking about that, Diana?
Yeah, I strongly believe that, cash should be serving a purpose. I think it's fascinating that folks still have money in what I'll call the traditional savings account that are paying, on average, 40 basis points, where there's other accounts like high yield savings that can return. I mean, these days it's dropped a little bit, because of the Fed funds rate, but, around 4%, maybe a little bit less. So you always want your money working for you. I think liquidity is important. I absolutely agree that you should have, some type of an emergency fund for unexpected expenses. I think the statistic that came up in the interview, I think it's something about, maybe 80% of Americans don't have access to $600 in liquid funds to pay an emergency expense. And so that's pretty scary. So absolutely, emergency fund, but even your cash can work for you. So there's high yield savings, there's money market accounts, there are T-bills. I mean, there are different types of assets that you can invest your cash in that are very liquid that you can access right away. I think in terms of how much you're investing in cash, again, it goes back to your risk tolerance, how much you feel you can afford to lose, what doesn't keep you up at night. But cash shouldn't be looked at as just, this essentially default behavior. There are vehicles where you can put your cash to work for you. So I think the first step is just understanding what those are and then making a simple transfer.
Yeah, I agree. So as we kind of wrap it up here, what are some final thoughts you can leave us with, Diana?
Yeah, I would say, when we talk about cash and investing in other asset classes like the bond markets or stock markets, I think, cash is really there to give you peace of mind. Many people, probably most people, have some type of emotional attachment to money, which makes a lot of sense. My late father would say, cash or money doesn't buy everything, or money doesn't buy happiness, but it buys everything else. So it's important. It makes sense. There's an emotional attachment. It can give us peace of mind. And the way I look at it is investing in other asset classes really gives you opportunity. And it's such a personal decision as to what that mix looks like. And understand there isn't just one rule of thumb. It really is almost, a gut check and then strategically aligning whatever those money goals you have with that, that risk tolerance and understanding how much you can invest outside of cash. So I'm Diana Perkins. I'm the founder of Trading with Diana, where I teach everyday people how to invest in the stock markets with confidence. You can learn more or reach me at my website at tradingwithdiana.com.
Awesome. Well, I appreciate you coming on the show, Diana. Yeah, my favorite quote is, money doesn't buy happiness, but it buys everything that makes you happy. So, another take on that. Yeah, it's very true.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.